Hey everyone, happy Thursday, August 17th. It's about 10:30 on the West Coast, and it's time for another market update. Going back to last week, we got a July producer price index. So that's inflation on the wholesale side. And that's important because eventually their prices get, passed down to us as the consumer. It was expected to be up 0.2%. It went up 0.3%. And then year over year, it jumped from 0.2 to 0.8. Markets didn't like that too much, but year over year, 0.8 is really not that bad of a number. Because like I said, it was at really low levels previously, and that, the way they do these year over year numbers, obviously that's going to affect it. Next thing we got was the Fed minutes. This was important. This came out yesterday, in fact. So basically, the Fed minutes are when, after their meeting, they release basically everything they talked about. And it's important because we can kind of get an insight on what the different members are talking about and maybe get an inkling of what they're going to do in their upcoming meeting. So the two important things came out of it. They don't feel that a recession is on the horizon, which I have thoughts about, but we shall see. And they also, it looks like a majority of the members seem to be on board with more rate hikes, which we didn't want to hear. The markets did not like that. Basically, they're saying, they're not going to be in a recession. We can hike more. So it's, obviously a lot can change between now and the next meeting, but the markets did not react well, and that didn't help mortgage rates. Next thing we got housing starts. So housing starts are up, but not enough. So let's take a closer look. So the ones that have SF, that's single family, and the ones without it, that's including multifamily, so apartments and stuff. So across the board, we had single family starts were up, starts were up. Year over year, single family starts are up 9.5%. But then you get into completions and permits, and you start to see the issue here. Completions were down 12%. Single family only up 1.3 and only up 1.4 year over year. Permits slightly up, which is good to see. But permits year over year are down quite a bit, 13%, and only up 1.3 for single family. The problem is the current household formation. So how many new housing units we need each year, where people are moving out, buying new houses, moving out from their roommate and getting their own apartment, things like that. Current household formations are at 2.07 million, almost 2.1 million. And completions are at 1.32 million. So almost 800,000 difference in completions are supply to our demand, basically. And then permits, which is future supply, is at 1.44. But even that is still far short of this 2.07 number. So basically just normal supply and demand. If we don't have enough supply and there's too much demand, then that's going to raise prices, and that's going to be price supportive for current homeowners, and that's going to make it a little more difficult because no price decreases should be on the horizon, given the supply and demand dynamic we got going here. Next thing we got was initial job claims. Expect to be at 240,000. They came at 239,000, so pretty close to expectations. But the job market still just seems strong, very tight. Continuing claims went up a little bit, but employers are definitely holding on to employees right now. Purchase apps pretty flat, down slightly last week. And still down, year over year quite a bit. I think 26%. But new builds. This was interesting. Purchase apps on new builds and new construction was up 36% year over year. So that just goes back to no existing inventory. Only game in town really is builders, and an only thing you can really apply for and buy is a new build these days. Miscellaneous stuff. So we got NHAB. Take a look at this. So this is the optimism index, housing market index for builders, basically how confident they feel in different things. So remember, anything above 50 is considered growth. Anything below 50 is considered contraction. Across the board, they came down, but still pretty good numbers. Buyer traffic is really low, and that's obviously has a lot to do with my side of things and rates being high. So the reasons they gave for some of the weakness in this report, and this is also after going up 7 straight months. So this is the first down month in quite a while. So rising mortgage rates aren't helping. High construction costs due to lack of workers, going back to that, labor stuff. Lack of buildable lots isn't helping. And then an interesting one, ongoing shortages of distribution transformers. So from my understanding, that's an important part of the getting the power to the houses. And I guess there's a big shortage of those across the country. And then you can throw in weather and smoke and all that kind of stuff. So that doesn't help buyer traffic. That doesn't help, construction and any of that stuff. So, so again, down a little bit, but still builders are doing pretty well for themselves these days, considering the application jump right there. 36% is a big number year over year. Average 30-year conventional jumped from 7.14 to 7.37. 7.37, if you remember, was the high last October. So we're basically hit the high. From this point on, we dropped last year, but I'm not sure if that's going to happen. We're going to see what's going to happen in the next couple of weeks, but we're basically at a high for the year, and if I'm not mistaken, a multi-decade high. So not good stuff with coming out. And the one I jumped on there, July retail sales, that didn't help things. Looks like people are spending more money. It was expected to come in at plus 0.4%, came in at plus 0.7%. Based on the credit card stuff, debt in this country, it seems like people are putting it all on credit cards, but that number emboldens the Fed. They're saying people are spending money, job market's strong, inflation's still going up, we can keep hiking. So that's the bad stuff that made the market react negatively, and rates jumped from 7.14 to 7.37. Important dates, we got the different inflation and job stuff coming up until before we get the next Fed meeting in September, towards the end of September. But we also get the Jackson Hole Symposium next week, which is where the Fed members get together. Oftentimes a lot of important data comes out of that. So we'll keep an eye on what happens there. But like I said, overall, we got to keep our eye on that Fed meeting. Right now, I think the markets aren't still, with all this going on, with the Fed basically saying we want to hike more, the markets still show an 86% chance they're not going to hike. They've been wrong before. They seem not to believe the Fed. So maybe a game of chicken going on there. But as of now, the market still doesn't believe them. But, again, like we talked about, prices are still going up or staying where they're at. Waiting is costing people money. If you can afford the payment, it's something you should definitely look into. But like we talked about, the tough part is for people on the margins. That's who's really being affected right now, which is unfortunate. It's first-time home buyers and people that could basically use the housing the most. So hopefully the Fed comes to their senses and stops driving, looking in the rearview mirror. So if anybody needs anything at all, please don't hesitate to reach out. I'd be more than happy to help. Have a great day, everybody.